Southwest Airlines Co., ticker LUV, Q2 2026.
Oh,
CEO Bob Jordan just reported results, and they came in well ahead of consensus expectations. Revenue hit a record adjusted $8.7 billion, which is up 20.3% year over year. Adjusted EPS came in at 94 cents. GAAP diluted EPS was 47 cents.
right.
And looking ahead, Q3 adjusted EPS is guided to 50 to 75 cents. Full year 2026 adjusted EPS guidance is now 3.25 to 4.25, replacing their prior expectation of, quote, at least $4.
I mean, right out of the gate, those are just massive, heavy-hitting numbers to digest. In a notoriously volatile industry like airlines, a 20% top-line jump, that immediately commands your attention.
Yeah, exactly. And so for you listening, our objective today is to completely tear down this income statement. We're going to look closely at segment performance and really assess the real margin drivers behind this report.
Because on the surface, we see those headline revenues jumping over 20%. But we need to unpack exactly where that growth came from and how it actually translates to the bottom line in what we all know is a really tough macro environment right now.
Yeah, so to really understand that 20% jump, you have to look past just the base passenger fares, right? You have to look at the commercial momentum across their specific revenue levers.
Because not all airline revenue is created equal.
Exactly. The report shows that managed business revenues hit an all-time quarterly record, up 30% year over year.
And just to clarify, that's corporate travel booked through travel agencies and portals?
Yep.
And that 30% spike is a massive signal. I mean, for the last few years, the entire airline industry has essentially been holding its breath, just wondering if corporate travel would ever fully recover to historical trends.
Yeah, and Southwest capturing a 30% year-over-year increase there, it tells us they're successfully grabbing market share among those corporate clients.
Which is the holy grail for airlines.
Oh, absolutely. They book later, they need more flexibility, and, consequently, they pay significantly higher average fares than a family just going on vacation.
Right, but the growth wasn't isolated just to the corporate side. What stood out to me was the Rapid Rewards program. Their loyalty program saw record engagement.
Huge numbers there.
Yeah, new enrollments were up 35%. That pushes total membership to nearly 100 million people. Think about the scale of that consumer database for a second.
It's crazy.
And right alongside it, acquisitions for their Chase co-branded credit cards accelerated by 28% year over year.
Which is where the business model gets really fascinating, for anyone analyzing this stock. When you look at modern airline economics, those co-branded credit cards and loyalty programs, they are incredibly high-margin revenue streams.
I always hear this phrase that airlines are basically banks that happen to fly planes.
Pretty much, yeah.
How exactly does that mechanic work? Like, why is a credit card sign-up so lucrative for Southwest?
Well, think of the airline's loyalty points as a currency they could basically print out of thin air. Southwest sells those Rapid Rewards points directly to Chase Bank.
Okay.
Then Chase uses those points to reward you, the consumer, every time you swipe your card for groceries or gas. So from Southwest's perspective, they get paid cold, hard cash up front by the bank for points that you might not redeem for years.
If ever.
Exactly, if ever. So it's basically a highly lucrative financial services business bolted right onto the side of an airline.
Wow. And the margins on selling those miles to the bank have to be astronomical compared to, the margins of actually flying a human being across the country.
Oh, night and day. So when you see a 28% acceleration in new credit card acquisitions, that's a stream of steady, high-margin cash flow. It acts as a massive financial shock absorber against the day-to-day volatility of flying planes.
Speaking of that volatility, let's look at the operating margin, because this is where the numbers almost seem to contradict each other.
Yeah, this part is wild.
The adjusted operating margin came in at 6.7%. That is a 3.3 percentage point expansion compared to the exact same quarter last year.
Okay, let's pause here. We really need to unpack this margin expansion history, because if we look at their fuel costs, Q2 fuel was $3.92 per gallon.
Which is high.
Very high. In nominal terms, that created a massive $889 million year-over-year increase in their fuel expense.
Almost $1 billion in extra costs just to fuel the fleet.
Right. So here is the puzzle for you listening. How in the world do you expand your operating margins by over 3 full points when your fuel bill alone goes up by nearly $1 billion?
It sounds mathematically impossible.
It really does. It feels like taking a massive pay cut at work, but somehow, putting more money into your savings account at the end of the month.
It's a phenomenal question, and the short answer is just raw, unadulterated pricing power.
No.
To understand the mechanism, you really have to look at the relationship between unit revenues and unit costs. So, looking at top-line efficiency, their RSM revenue per available seat mile spiked 20.1% year over year.
So they generated 20% more revenue for every single seat they flew a mile.
Exactly. Now, what about the unit costs? That's the other half of the equation, measured by CSMX, the non-fuel unit costs.
Right, because they strip fuel out so management can track operational costs they actually control, like labor and maintenance.
Exactly. And their CSX only increased by 3.4%.
Ah, okay, so I see the math now. Your unit revenues are growing at a 20% clip, but your non-fuel unit costs are only creeping up at 3.4%.
Right. That massive spread, that widening gap between what they pull in per seat and what it costs to fly it, is what absorbed the entire billion-dollar fuel hit. It just ate the fuel increase and still dropped a 3.3-point margin expansion straight to the bottom line.
But how do they practically achieve that 20% spike in unit revenue? You can't just ask nicely for 20% more money.
You do it through highly aggressive yield management and capitalizing on demand constraints. They knew corporate travelers were coming back, and they knew overall industry capacity was tight.
So they held firm on pricing.
Exactly. They successfully passed those inflated fuel costs directly onto the consumer through higher average ticket prices, and the consumer, whether it was a business account or a leisure traveler, was willing to pay it.
So the consumer absorbed the fuel shock, and the airline kept the expanded margin.
Yep.
That is just a massive display of pricing power. But to really understand the true operational run rate here, we have to look under the hood. We have to bridge the gap between their GAAP numbers and those adjusted numbers.
Yeah, because there is a very significant accounting quirk in this quarter that anyone analyzing the stock needs to grasp.
Right. In the headline numbers, we mentioned GAAP diluted EPS was 47 cents, but the adjusted EPS was double that at 94 cents.
Yeah.
The culprit here is a $285 million special item.
It's what the industry calls a breakage revenue adjustment. Sometimes, strict GAAP accounting doesn't perfectly reflect the actual cash operating performance of a single quarter. And this breakage adjustment is a perfect example of that.
Right, because between 2022 and 2025, Southwest issued flight credits to customers who canceled trips, and they made these credits non-expiring.
Right, and breakage is basically the portion of credits that a company assumes will just absolutely never be used.
The forgotten money.
Exactly. Accounting rules allow the airline to recognize that unused credit as revenue today based on historical data.
Wait, let me make sure I have this straight. It's like a major retailer who sells millions in gift cards. They know statistically maybe 5% of those gift cards will get lost in a junk drawer.
Right.
So instead of keeping that 5% as a liability on the books forever, they eventually just write it down and claim it as revenue.
That is the exact mechanic.
Yeah.
Southwest had previously recognized some of that breakage revenue based on their models, but the problem is consumer behavior is shifting dramatically right now.
Because of inflation.
Most likely, yeah. Consumers are feeling the pinch. So instead of booking a new flight with cash, people are digging through their emails, finding those old, non-expiring flight credits from 2022 and actually redeeming them.
They're cashing in the gift cards from the junk drawer.
Exactly. Which means Southwest has to put passengers on planes without collecting any new cash today, because that cash was collected years ago.
Right.
Customers are redeeming these credits at a much higher rate than projected. It forced Southwest to make a 3 percentage point increase in their redemption assumption. And since they already claimed that money as revenue in the past, they had to reverse $285 million of it this quarter.
That's a massive hit.
It is. It hits the GAAP income statement right now. But management strips it out of the adjusted numbers because they argue it's just non-cash historical accounting noise.
It reflects consumer behavior from years ago, not the operational performance today.
Exactly.
That makes total sense. Now let's pivot back to actual operational costs. We mentioned the CSMX metric, the non-fuel cost structure. Q2 CSMX was up 3.4%, which actually beat guidance.
Right.
But looking ahead, Q3 CSMX is expected to rise 3.5 to 4%.
And what really stands out there is a highly specific physical driver for this cost headwind. Management explicitly noted a 1.1-point impact on unit costs just from removing 6 seats from their Boeing 737-700 fleet.
Wait, they are physically pulling 6 seats off of those airplanes?
Yes. They're retrofitting the cabins for extra legroom seating.
Look, I'm looking at the math on this, and I have to ask.
Yeah.
How does this make sense from a purely financial perspective? We're in a capacity-constrained environment with high structural costs. Is sacrificing 6 revenue-generating seats per plane an acceptable penalty?
Well, walk me through your thought process on the math there.
You're flying the exact same heavy metal tube through the sky. The fixed costs are identical. You paid the 2 pilots the same salary, same maintenance, same landing fees.
Yep.
But now you're dividing those identical fixed costs by fewer seats. You're shrinking the denominator. Doesn't that just inherently force your cost per seat to go up?
It absolutely does. You're dead right on the math. It's an immediate mathematical penalty to their CAS and X. But this raises a much deeper strategic question about brand equity and yield management.
How so?
Southwest has a 5-year streak as J.D. Power's #1 airline in economy customer satisfaction. To maintain that, and more importantly, to capture that highly lucrative business traveler we talked about, they need to offer a premium product.
Because corporate travelers want legroom.
Exactly. So this is a calculated gamble. They're betting that the premium pricing for those specific extra legroom seats, plus the corporate loyalty it generates, will bring in more total revenue than just selling 6 standard seats.
It's a fundamental shift then. They're moving from a high-volume, pack-them-in strategy to a yield play.
Yes, betting that lower capacity but higher quality cabins will support that continued Erasmus growth.
But that's a tightrope walk. If the macro environment softens and corporate budgets get slashed, they're suddenly left with structurally higher unit cost and empty premium seats.
Exactly. It's a high-stakes bet on the resilience of the premium consumer.
Well, that structural cost shift brings us naturally to the next piece,
Mhm.
capacity discipline and their broader network strategy. Because stripping out seats impacts total capacity. Let's look at their network plans and the real risks threatening their sleep pipeline.
Right.
Q2 capacity, measured in available seat miles or ASMs, was essentially flat, up just 0.2%.
And looking forward, that intense discipline continues. Q3 capacity is expected to be down 1% to flat. Even more significantly, their full-year 2026 growth target was slashed from 2% down to roughly 1.5%.
That seems like a very deliberate throttling of supply.
It's the ultimate defense mechanism an airline has to protect its pricing power. Keep capacity tight, ensure load factors stay exceptionally high, and you can maintain elevated ticket prices.
To protect that 6.7% margin.
Exactly, but there's another layer here. It isn't just a strategic choice by management.
It's a physical constraint.
Yes, it's mechanical.
Because, looking at the fleet mechanics in the report, in Q2, Southwest received 13 new Boeing 737-8s, but retired 10 older aircraft. So net, they only added 3 planes, maintaining a total fleet of 803.
And this is where we need to dive into the forward-looking risk factors. Because this slow growth is about severe supplier bottlenecks. Southwest explicitly highlights a critical vulnerability: their 100% dependence on the Boeing company.
Ah, the famous single fleet strategy. They only fly Boeing 737s.
Which historically, for decades, has been their greatest competitive advantage.
Right, because of operational simplicity.
Wow.
Every pilot can fly every plane, mechanics only need one set of training, spare parts are uniform.
Infinite flexibility, yeah. But now it's becoming a massive liability.
Because of the delays.
Yes. The report specifically calls out severe delays in the Boeing MAX 7 aircraft certifications and their heavy reliance on the FAA to get those planes approved.
So consider the structural risk here for you as a retail investor. You're looking at a company whose entire multi-year growth pipeline is tethered to a single supplier.
A supplier currently mired in massive delivery delays and regulatory scrutiny.
Exactly. It creates an absolute ceiling on their agility. If Boeing physically cannot deliver the new MAX 7s, Southwest has no good options.
They either extend the life of older, less efficient planes, which hurts margins, or they cut their growth targets, which we are already seeing them do, down to 1.5%.
And because of their infrastructure, they can't just pick up the phone and order from Airbus.
Oh, no. The switching costs would be astronomical.
Really?
Retraining thousands of pilots, new maintenance facilities, they are entirely locked in.
So if your main supplier is struggling and fuel is volatile, your only reliable defense mechanism is a fortress balance sheet. Let's look at their liquidity, leverage, and capital allocation.
This is an area where Southwest traditionally outshines its peers, and the Q2 numbers support that narrative.
Running through the stats, they ended Q2 with $5.3 billion in total liquidity. That's $3.8 billion in cash on hand, plus a $1.5 billion revolver. Gross leverage sits at a very healthy 2.1x.
Yeah, that 2.1x gross leverage ratio, calculated using adjusted EBITDA, which adds rent back into the earnings calculation, is highly competitive.
It essentially means they aren't suffocating under their own debt interest payment.
Exactly. They have breathing room.
And here's a massive safety net from the balance sheet. They reported unencumbered aircraft and assets with a net book value of approximately $15.7 billion.
Unencumbered assets are critical. It simply means Southwest owns those planes outright. No bank loan or lease tied to them.
They hold the pink slips to $15.7 billion worth of aircraft.
Which is the ultimate downside protection. If credit markets freeze or another macro shock hits, they can use those planes as direct collateral to raise emergency cash.
So the defense is incredibly strong. How are they playing offense with that capital?
They're returning it to shareholders, but very cautiously. They distributed $88 million in Q2 dividends, and they still have $450 million remaining on their share repurchase authorization.
Buying back stock, but simultaneously pulling back hard on capital expenditures.
Right.
2026 net capital spending is being aggressively managed. They expect it to come in at the low end of, or maybe even below, their $3.0 to $3.5 billion range.
Which perfectly aligns with the Boeing bottlenecks. If you aren't getting planes as fast as you planned and you're intentionally slowing growth, you inherently don't need to spend as much capital.
Managing CapEx down preserves cash flow.
Exactly. It supports the dividend and buybacks while they wait for the supply chain to normalize. It's a very pragmatic holding pattern.
So taking a step back, we've torn down the revenue drivers, the margin expansion despite fuel, the accounting noise, capacity discipline, and the balance sheet.
And when you synthesize all of this, you see a management team pulling every lever to optimize a complex machine. But Bob Jordan noted something retail investors need to watch closely. He stated this was the first full quarter with all of their, quote, transformational initiatives finally in place.
Ah, right. The Starlink-equipped aircraft, the new airline partners like Air Premia.
Exactly. Southwest is actively trying to evolve away from the pure legacy low-cost carrier model to an experience that commands a higher yield. And that leads to a critical forward-looking question.
What is?
If the macro picture tightens and the consumer weakens, will premium offerings like extra legroom and Starlink be enough to maintain this record 20% unit revenue growth? Or will Southwest find that travelers ignore those features, forcing them to rely entirely on brutal cost-cutting to defend that 6.7% margin?
Follow the show for your daily earnings coverage.